Big banks releasing their forecast for 2011. This morning, another bullish call from JPMorgan. Chief U.S. equity strategist Thomas Lee calling for 1425 on the S&P next year. That's a gain of about 15% from where we are now. He joins us first on CNBC. Thomas, good morning. Thanks for being with us.
Hey, Mark. How are you?
Why this bullishness, this optimism?
Well, there's a lot of reasons to be constructive. Some obvious ones like, GDP, upside momentum. It's also the fact that equity risk premiums at 60-year highs and expected returns of fixed income are actually flat to negative. But I think history is also really making a very strong argument. This is the third year of an expansion, third year of a presidential cycle. Both actually have only happened 5 times in 115 years of Dow history. The market's averaged 21% gains. I can see it being a big deal this year because, businesses have been very cautious. They have huge cash positions. I think when you see third year of an expansion, they're a lot more comfortable. You'll see the cash deployed. And, in terms of Washington, I think they're moving towards the center, which is also good news.
But I guess, what holds people back, what has them wary is the nature of this recovery. Yes, things are getting better, but good Lord, it's going so slowly.
That's right. It's a slow motion recovery. It's been hurt by, still a very, very big morass in housing, and I think the lack of credit expansion. We spent some time in the report really thinking that, one of the interesting developments this year may be that in some cities in the U.S. this year, there'll be shortages of housing. Household formation typically rebounds in the third year of an expansion pretty dramatically. We already know vacancies are pretty low on some of the coastal cities. We know apartment rents have been rising mid-single digits. So it's really a formula for a bottom in housing to take place in a lot of cities.
Hi,
this
Thomas.
year.
I'm going to join the conversation. What is different about your market strategy for 2011 from this year?
Oh, hey, Mandy. I think that's really I think this is going to be a very tough year for active managers because we looked at 50 years of market history, tracked 30 industry groups, and what we found is that in the third year of a bull market, sector rotation is actually the greatest. So we think that this year is really going to be broken up into thirds, where in the first third of the year, you want to own credit sensitives like the insurance companies, the asset managers, the consumer cyclicals. In the summer, make a big shift into the industrial cyclicals, including energy and airlines. But then by the final third of the year, you really want to be very, very heavily focused on defensive. So it's going to be we have a roadmap in the report, but I think it's going to be a very, very confusing year.
What's the number one risk to all of this, Thomas? What would derail your bullishness? One single thing.
Well, I think the biggest risk, because its transmission so quick, is if sovereign Europe becomes systematic. Because we know that it's going to affect banks, it's going to contract credit, and then it's going to immediately affect the U.S. banking system. So, that's probably the biggest risk right now.
Is that a big risk? Is that a high chance for you?
We've spent a lot of time talking to our various teams. We think it's actually a tail risk of a systematic crisis. Less of a tail issue, but I think it's substantial, is that Europe slows, that the contraction of credit slows the economy. But that really has an effect on just a few industries in the U.S., not in the entire market.
If you are correct, then I would do pretty well just by buying spiders, right?
I think the S&P will be, being long, just the index should be fine. In terms of style, we think larger cap probably does better than smaller cap, so the S&P over the Russell. And lower PE stocks probably do better than higher PE stocks next year as well.
I have to ask you, what is your outlook for the dollar, and how does it jive with your equity strategy, considering that, recently a strong dollar has been a headwind for equity, but doesn't necessarily have to be so, right?
That's right. The relationship between the dollar and equities, it's really unclear what kind of linkages exist. In general, we do think a monetary easing cycle leads to weakening currency, and especially when you look at the strength, the need for tightening in emerging markets. So I think you really are going to look at a dollar that trends lower over the year.
All right, Thomas Lee, thank you very much, sir.